Welcome to the Opening Bell Report.
Okay, picture the scene. It's a Friday night, the markets are closed, the work week is finally done, and you make that classic fatal mistake of checking your portfolio just as you're about to pour a drink.
Oh, never look at the portfolio on a Friday evening. It ruins the weekend every single time.
It really does.
Yeah.
And for anyone holding HIMS and HERS, that's ticker HIMS, last week, it wasn't just a bad day, it was a massacre.
Yeah.
You open the app and you just see a sea of red, a massive candle on the chart. The stock plummeted, what, 16% in minutes?
It was a violent move. High-volume panic selling, the kind of drop that makes you question your entire thesis on a stock.
Exactly. And if you tuned into the financial news or scrolled through, X, the sentiment was apocalyptic.
Oh,
It
yeah.
was all, the party is over, get out now, and Big Pharma's coming to crush them.
Which is the standard emotional response to regulatory headlines. The market shoots first and asks questions later.
That's why we're here. We aren't here to panic. We're here to look at a fascinating analysis report titled, Why I'm Buying the HIMS Dip.
A bold title.
Very bold. The subtitle is Market Panic Equals Your Gain. So we have a very clear conflict today. The market says HIMS is dead money, but this analysis argues it's the buying opportunity of the year.
It's the classic contrarian setup. The report is essentially arguing that the market has mispriced a specific risk, the legal risk creating this massive dislocation between the stock price and the actual value.
Right, but let's be real for a second. Catching a felling knife is dangerous.
It is.
Usually when a stock drops 16% on legal news, there's some fire behind that smoke. So my job today is to be the skeptic. I want to know if this report is actually onto something.
And that's fair. We need to dissect the bear case before we can even look at the bull case.
So let's start there, the catalyst. Why did everyone hit the eject button at the same time?
It was headlines. Specifically headlines regarding Big Pharma, Novo Nordisk, and Eli Lilly.
Okay.
As you know, HIMS and HERS has seen explosive growth recently by selling compounded GLP-1s.
Right, the weight loss gold rush. These are basically the off-brand versions of Ozempic and Wegovy.
Exactly. But Novo and Lilly hold the patents. They've spent billions developing these drugs, and they are, let's say, not happy that compounding pharmacies are selling essential copies for a fraction of the price.
Understandably.
So the headlines hit that these giants are launching a new wave of legal threats to shut the compounders down.
And the market reads legal threat and just interprets it as game over.
Precisely. The assumption is that Lilly has infinite lawyers, infinite money, and they will just steamroll HIMS into the ground.
So the market is pricing in the absolute worst-case scenario.
Right.
An immediate injunction. A judge signs a paper tomorrow, and HIMS weight loss revenue goes to zero.
Overnight, that is the fear that caused that 16% drop.
Okay, so that's the fear. But the analysis report we're looking at says this is a fundamental misunderstanding of how the FDA works.
It really does.
So walk me through the counter-argument. Why isn't this an open and shut case for Big Pharma?
It's because of something called the shortage list. This is the critical piece of the puzzle that the headlines often skip over. Under FDA Section 503A and 503B, compounding pharmacies have a federal exemption to manufacture drugs when the branded versions are commercially unavailable.
Meaning when they are on the FDA's official shortage list.
Exactly. So as long as you can't just walk into a CVS and easily get Wegovy, HIMS is legally allowed to sell the compounded version.
So it's a safety valve in the regulations.
It is. It's to ensure patients can get treatment. The legal argument from Big Pharma is essentially trying to challenge the quality or the marketing of these compounds, but the report emphasizes this is a regulatory gray area, not a black and white violation.
But here's the thing, and this is where I get stuck on. The risk shortage lists aren't permanent.
They're not.
If Lilly ramps up production and the FDA says the shortage is over, doesn't that exemption just evaporate?
It doesn't happen with a snap of the fingers. The report goes deep into this timeline. Even if the shortage was declared over today, there's a wind-down period. But more importantly, the legal battle over when and how to stop is going to be a war of attrition.
So it's not a light switch. It's more like a dimmer switch that might take years to turn down.
Exactly. We are likely looking at years of litigation, appeals, stays, and negotiations. The market is acting like the revenue stops this Friday.
But the reality is different.
The reality is that HIMS has a massive legal team. They are operating under a federal statute, and this process will drag out.
The report used an analogy here that I found pretty compelling, the Uber comparison.
Yes, this is a great mental model. Think back to, 2014 or 2015? Uber was getting sued by practically every city on the planet.
Oh, I remember. Taxi commissions, local governments, unions, everyone wanted them banned.
They said it was illegal, unsafe, unregulated. Headlines every week about Uber being banned in London or Paris.
And if you sold Uber stock every time a city threatened a ban, you missed one of the greatest growth stories of the decade.
Right. Uber didn't fold. They adapted. They litigated, they lobbied, they tweaked their model. The report views HIMS in the same light. They are disrupting a legacy industry pharma distribution, and the incumbents are fighting back.
So the argument is, don't mistake a regulatory negotiation for a death sentence.
That's it. The dip is caused by investors who want certainty. But, as the report points out, by the time you have certainty, the stock will be double the price. You get paid for taking the risk.
Okay, let's pivot to the numbers. Because even if the legal risk is overblown, that doesn't automatically make the stock a buy. Sometimes a stock crashes because it was just wildly expensive to begin with.
And HIMS is a high-growth tech stock. Usually those trade at, nosebleed valuations.
So is it just too expensive?
That's the wild part. Before this crash, HIMS wasn't even that expensive relative to its peers. But now, the valuation dislocation is pretty extreme.
Break down the math for us.
So pre-crash, HIMS was trading at a price-to-earnings multiple of around 43.
Okay, high, but not insane for their growth.
Right. But after the drop, and looking at forward earnings, they are trading closer to 30 to 35 times earnings.
30 times earnings is still a premium compared to, say, a bank.
Sure, but you can't compare a rocket ship to a tractor. You have to look at the growth rate. HIMS is growing revenue at 49% year over year.
Almost 50% growth. That's huge.
It is. And usually if a company is growing at 50%, the market assigns it a PE of at least 50, if not higher. When you have a PE of 30 and growth of 50, you have a PEG ratio, that's price earnings to growth, of significantly less than 1.0.
And for anyone who doesn't follow the Peter Lynch style of investing, a PEG under 1 is basically the holy grail.
It is the screaming buy signal. It implies that the market is fundamentally mispricing the growth. You are paying a value stock multiple for a hypergrowth company.
But isn't there a catch here? Usually when a stock trades at a PEG under 1, it's because the market thinks the earnings are fake or they're about to collapse.
It's the value trap scenario.
Right. The market is saying, we don't believe that 49% growth is sustainable because the FDA is going to shut it down.
Exactly. That is the wager. The market is discounting the future earnings because of the fear. But the report argues that even if you strip out the hype, the fundamentals are rock solid.
How so?
This isn't a company burning cash to achieve that growth.
That's a key distinction. A lot of telehealth companies grow by spending $2 to make $1.
They just light money on fire to acquire customers. HIMS is the opposite. They are what the report calls a cash flow machine. They have positive net income around 126 million TTM.
So they're funding their own growth.
Yes. They aren't diluting shareholders or taking on massive debt to keep the lights on.
Which brings us to the comparison that always comes up, Teladoc. Teladoc was a disaster for investors. Why is this different?
It's a totally different business model disguised as the same industry. Teladoc sells to insurance companies and employers. It's a B2B utility, a race to the bottom on pricing. HIMS is a direct-to-consumer brand.
And the margins prove it.
Oh, yeah. The report highlights this heavily. 75% gross margins.
Let's just pause on that. 75% margins on physical products? That's insane.
Yeah.
Apple has margins in the 40s. How do you get software margins when you have to manufacture and ship actual pills?
Because they aren't just selling pills. They are selling access, speed, discretion, the consultation, and the recurring subscription.
Full package.
They've verticalized the process. So their cost of goods is low. Generic sildenafil is cheap to make, but the price point is premium because of the brand wrapper.
So they have the unit economics of a SaaS company, but they're moving atoms.
Correct. And that high margin is their moat. It gives them a massive war chest. If you are making 75 cents on every dollar, you can outspend competitors on marketing, you can hire better lawyers to fight the FDA, and you can innovate faster.
A luxury Teladoc never had.
Not at all. Their margins were always squeezed by the insurance companies.
So the financials are robust. They have cash, they have margins. But I want to go back to the doomsday scenario. I'm the skeptic, remember?
I do.
Let's say the bear case is right. Eli Lilly wins, the FDA crackdown is swift, and HIMS is banned from selling any weight loss products starting tomorrow. Does the stock go to zero?
This is maybe the most critical part of the report, what it calls the safety net argument. And the answer is a resounding no.
Because HIMS isn't just an Ozempic shop.
Far from it. The media narrative has become HIMS equals weight loss, but this company was a unicorn before they sold a single dose of GLP-1s. They have 3 other massive pillars.
Hair, skin, and sexual health.
Exactly. And these are incredibly sticky businesses.
Right. If you start using minoxidil for hair loss, you don't just stop unless you want your hair to fall out again.
These are lifetime subscriptions for many users. The report argues that the core business, if you exclude weight loss entirely, is still growing double digits and generating massive cash flow.
So the thesis is, at the current price, you are paying a fair price for just the hair, skin, and sexual health business.
Precisely. You are buying the core business at a discount, and you are getting the entire weight loss business as a free option.
I like that framing, the free option. Basically, if the weight loss segment survives, even at 50% capacity, it's pure upside.
And if it dies?
You still own a profitable, growing telehealth company.
That's the asymmetry the report loves. The downside is capped because the core business supports the valuation. The upside is uncapped because if they win the legal fight, the stock is a potential multi-bagger.
It's like the market is assigning a negative value to the weight loss business right now.
It effectively is. And that's where the dip hunter steps in. The report mentions the RSI, that's the relative strength index, is just screaming, oversold. The technicals align with the fundamentals here.
But let's talk about the psychological difficulty of this trade. It sounds great on a deep dive. Buy the fear. But when you open your brokerage app and you see that red line, your lizard brain just screams, run.
That's the hardest part of investing, isn't it? It's easy to be a contrarian when the market is flat. It's really hard when the market is crashing. The report acknowledges this risk. It calls it legal noise.
You have to be willing to ignore the headlines for the next 6 to 12 months.
And brace for volatility. Because even if this analysis is right, Big Pharma isn't going to stop issuing press releases. The stock is going to swing.
Oh, it will be a roller coaster.
For sure. But the report's strategy is clear. I'm not selling, I'm accumulating. These dips are viewed as gifts. The author believes that in a year or two, when the dust settles and the earnings reports keep showing profit, the market will look back at this panic and feel foolish.
It's that time arbitrage concept. You are willing to hold through the messy middle to get to the clear outcome on the other side.
Precisely. The market has a very short attention span. It focuses on the next week. The investor can focus on the next decade.
So to wrap this up, the report's verdict is pretty clear. The risk is real, but it's priced in and then some.
The verdict is risk equals legal noise. Reward equals multi-bagger potential. It's a high conviction buy, according to this report.
And for you, the listener, I guess it comes down to what you believe. Do you trust the FDA regulations and a shortage list mechanism to hold up?
Or do you think Big Pharma's pockets are deep enough to rewrite the rules? And are you looking for a safe 5% return or a volatile 100% return? This isn't a trade for the faint of heart.
Definitely not. But you know the saying, scared money don't make money.
Warren Buffett phrased it a bit more eloquently, I think, but the sentiment is the same.
I'm paraphrasing. But seriously, this has been eye-opening. It's so easy to get swept up in the headline panic.
It is.
But when you actually pop the hood and look at the engine, the cash flow, the margins, the legal nuance, it looks a lot less like a car crash and a lot more like a pit stop.
A pit stop with a very attractive price tag attached to it.
We'll leave you with that thought. Next time you see a sea of red in your portfolio, ask yourself, is the house on fire or is it just on sale?
That is the question.
Thanks for diving in with us today. We'll catch you on the next one.
Thanks, everyone.
Don't forget to like, share, and subscribe for more.